The post-election market rally is here and it's making waves. But what does it actually mean for you as a long-term investor? With stock valuations soaring above historical averages, it's tempting to celebrate these gains like it's a never-ending party. But savvy investors know the key is staying focused on long-term goals and not just short-term fireworks. So here's the scoop. Economic fundamentals are holding strong. We got steady corporate earnings, solid GDP growth, a fresh cut from the Fed, and unemployment levels are still pretty low. So what's the big picture in this market rally? Is it time to double down, play it safe, or somewhere in between? Stick around because we're going to break it all down for you as we navigate these exciting times like a pro. Let's get into it. Let's talk stock valuations. This chart takes us on a journey through today's numbers, last year's figures, and how they stacked up against historical trends since 2003. And the verdict? Valuations shot up like a New Year's Eve firework. Across several measures, they're hovering around the high water marks of the past 2 decades. The post-election rally brought big wins across major indices, with Bitcoin smashing through 100,000 and S&P's price-to-earnings ratio creeping uncomfortably close to dot-com bubble territory. But here's the deal. While short-term market moves can swing like a festive piñata, remember the volatility after the 2016 election? Valuations remain the most reliable long-term indicator of investment returns. Markets can play fast and loose with fundamentals like earnings for a while, but eventually, one of two things happen. Prices adjust or earnings catch up. The market rally, it's not just the economy, it's the vibes. Part of the surge comes from investor enthusiasm over anticipated policy changes after the election. But while short-term market moves are a reflection of sentiment, sometimes overexcitement, long-term performance boils down to one thing: fundamental value and earnings. Here's the catch. Markets have a flair for the drama, often overestimating both the good and the bad. Let's wrap it up with the ultimate investing truth. Diversification usually wins. This chart highlights annual total returns across different asset classes, and here's the kicker. It's practically impossible to predict which ones will shine or stumble each year, despite all those talking heads on TV right now telling you they know which one's going to win in 25. Right now, U.S. stocks are flexing their muscles while other asset classes like international stocks are posting solid, though smaller gains. Yes, valuations are high, but the fundamentals are still strong. Steady corporate earnings, robust GDP growth, and a Fed that's already easing. Here's the big picture. Long-term economic trends drive investor success, not the short-term roller coaster of market movements. That's why maintaining a balanced and diversified portfolio is one of the keys to weathering uncertainty and reaping long-term rewards. I hope this quick tour of the market rally gave you some valuable insights. If you have questions or want to chat about your portfolio, don't hesitate to reach out. Let's make sure your financial strategy is as strong as the markets are right now.